Welcome to the Finance Village podcast, where we navigate the dynamic relationship between financial professionals, their industry, and the clients they serve in an ever-changing landscape. We open important topics and gather as well as challenge the insights of advisors such as financial planners, mortgage brokers, accountants, realtors, and more. Join us as we delve into the intricacies of finance, the financial industry, and financial professionals, as well as their profound impact on individuals and communities. It takes a village of advisors to take good care of any client, and a village of comrades in this industry for us to see great success together. Let's begin. Welcome everyone to another episode of Finance Village, and I am your host, Sheldon Bro. In this conversation, we've got Brandon Chapman. He's the founder of AdvisorFlow. AdvisorFlow helps advisors streamline operations, simplify compliance, and deliver a better client experience, which is, of course, what every professional wants to do, and really turning those client relationships into a more collaborative and automated experience with one location for intake forms and updates to client information. He's got over 8 years of experience in financial and business planning, and helps Canadian businesses and professionals thrive with strategic advice and technology. Do I have that number of years right, Brandon?
Yeah, you nailed it.
Okay. I know that you specialize in wealth management solutions and also specializing in tax efficient strategies for incorporated individuals, and you're passionate about innovation for your clients, and certainly giving the same advice I would hope that it would give your own mother. In this conversation, we're going to get some of your expertise and insights on both the financial technology space, but also on the financial planning side. But I'd like you to start out by telling us a brief overview of your origin story within finance and fintech. People come from all walks of life. I certainly had no plans to get into financial technology myself. So tell us a little bit about how you ended up deciding to go down the path of finance at all.
Well, first of all, Sheldon, thanks for having me on. I appreciate all the work you do to help push forward financial advice in Canada and help elevate the experience for clients across the country. So I actually had a different technology company before entering financial services, one in which I didn't have domain expertise. And I was approached towards the tail end of my degree about joining financial services. So I started with Freedom 55 Financial in Vancouver. That firm no longer exists, and it's a bit of an issue, I think. There's recruiting in general in the independent advice channel. It's becoming more and more challenging. But basically I knew I wanted to start a business. I liked the idea of an advisory practice because I could help people in my network make great financial decisions while building a business. Over time, from client feedback and some market research, as well as conversations with fellow advisors, it became pretty clear there needed to be better solutions for advisor-client relationships, since it wasn't a priority of the dealers or the MGAs. Basically, independent advice needed some help, and that's why AdvisorFlow started.
And you've just recently had your first child. Congratulations. What are some of the steps that you're taking to manage? Because I had my first child 3 years ago, in the midst of multiple similar situation to yourself. I have a mortgage advisory firm as well as the fintech company. What are some of the steps that you're taking or that you anticipate taking, or are you taking no steps at all to now manage both the family business at home, co-CEOing that with your spouse, and then you've got two businesses? What kind of changes are you looking at for efficiencies or disciplines or things that you're being very intentional about right now?
Well, Sheldon, I probably still have lots to learn, so I'd like to probably ask you this question, but it's been a week so far. Definitely still lots to learn, but so far, time blocking, work from home helps, and of course, regular check-ins with my wife. She has a mat leave program through work, so she's taking a bit of time off. We've got substantial family support available, which is pretty unique. My wife comes from a Filipino background, and so it's a bit of a different style, I would say, to what maybe other families are used to. And luckily, my two businesses, they work really well together, just like yours do. When you're at conferences, there's usually multiple people you can meet with that are beneficial to both businesses. And so ultimately, it comes down to a matter of team and time management. Each Monday morning, I have all my team meetings. We use Slack and Asana. Tech efficiency is ingrained into how I operate both businesses.
And I'm actually glad that you mentioned, just even from my side. So two things. Number one, make sure you teach the baby at a very young age. And I've always liked to throw my little food tips in because I'm a master chef. I've been baking since I was 9, grew up with my grandmother. Remember to teach the baby to boil the longaniza first. If you just put it on the pan like I did for so many months, and then you go to cut it open to make sure it's cooked in the middle, it all squirt out all over your shirt, then you got longaniza juice all over your nice white shirt. You go through a lot of shirts, it gets very expensive. So that's number one. Number two is I am constantly, and I'm so lucky, and from what I see you post about your wife, recently getting passing, I think the bar exam not too long ago, was it? We're really ambitious. We're very focused on efficiency, always trying to find different ways. And I'm constantly evaluating my household in a similar way to I'm evaluating my businesses. It can never be efficient enough. Efficiency doesn't mean I'm cutting out things that are important and I'm just trying to go to the business and I'm being, you can still do things efficient and lovingly, and taking the moments to not just rush and change a diaper, but talk to the child while you're doing a diaper change. But looking at your tech stack for your household. There's a lot of things that you can do within your household, just like within your business. And this is why I always am shocked when advisors are not looking this, because if advisors are not looking at this, because we all want maximum efficiency so that we can get our time back. Everybody on their service is working for time, right? Time is the most valued thing. It's what we want to get optimized, and being efficient and productive with your time doesn't just mean in your business. It means if I'm hanging out with my child, my wife, my grandparents, whoever it is, I want 100% enjoyment of that time. So you're allowing advisors to do that with your technology, but you're also allowing clients to do that with the financial planning, because nobody wants to have 65% enjoyment and 35% financial stress, even 80% enjoyment, 20% financial stress, and that underlying kind of distraction of your psychology in the background. So I'm always looking at my technology stack and the way that I block my time. Every week I relook at it to see if there's ways that I can improve, see if there's ways I can, learn from somewhere that I can improve that. And there's things that definitely my wife and I, when we're coordinating our schedules, we're coordinating things that we want to be able to achieve together personally and professionally, using some of these technologies. And even not necessarily a Slack for your household, but there's a lot of cool things out there that we can use to kind of, make sure we're collaborating with each other in a really effective way. And what we both do within financial technology is really trying to increase that collaboration. So tell me about just the importance of collaboration in financial planning. I've had a lot of experiences growing up in the last almost 20 years in the financial industry where I had so many stories where advisors lost track of where their clients were after the strategic meeting. You send them back out into the wild. Maybe you talk to them once a year, twice a year, once quarterly. How important is that collaboration? And give us a little more insight into how advisor flows helping to make sure that we're coordinating more intelligently on an ongoing basis.
Yeah, well, I think ultimately advisors are overwhelmed. There was a history of lack of innovation, I would say, for financial advice, specifically in Canada, for a couple decades. And so very much a pen and paper business. I call it the old trunk slammer, where there's paper files in the back and they're driving from house to house. Now we're sort of evolving quite quickly, largely due to the pandemic. And advisor flow, I use it as a way to ensure, and many advisors use it as a way to ensure they're getting up-to-date information from their clients on a regular basis. Outside of using PDFs and Word documents and phone calls, there simply wasn't a streamlined way for advisors to do that on a regular basis. Of course, now with your product and some data aggregation, that's going to allow advisors to get some information on a regular basis. Where we're helping is sort of getting specific information at particular points in the planning process. Now, I recently in my own advisory practice started doing a little more social media. This was about a year ago. I always was active on LinkedIn, but I found more of my clients were spending time on Instagram, TikTok, these other platforms. And so we started creating content to stay up to date with clients in different places where they're hanging out. So historically, advisors were probably out physically in the community and seeing their clients out there. That still might be the case, but if you look at a percentage of a human's time today, specifically those under 35, you can say that there's an increasing amount of time being spent on digital platforms. And if an advisor is spending 0% of their time on those platforms, they're increasingly getting less time in front of their clients. And so that's why we've made a strategic decision to spend more time in these digital spaces to ensure that clients are seeing us there and not just influencers or Bitcoin advocates that may skew perceptions of reality.
Well, yeah, and that's a big conversation on its own. I want to have another podcast I might invite you into. Is that there's so much different advice from people that want to be influencers, and even I saw one the other day where a buddy was promoting the Amex Cobalt. It's like the best rewards in the business, but he doesn't realize the infrastructure in the background means that this means it's significantly the highest fees for the business owners. It makes it very hard for them to run their business. There was just recently in the news over the last few days in the US where they're actually going to be changing the laws around those fees because it makes it so hard for those retailers. And a lot of, I think, so I ended up applying for that card, and I got into kind of like in the comment section, a friendly kind of like challenging it with him and to say, well, and it's also only accepted at about like, 25-30% of the places that that you'll typically go. I mean, maybe if you're just going to these big brands that don't care about those fees because their margins are so high, but there's a lot of nuance, I would say, I guess, and that's really where we bring the value even versus AI. I mean, AI can only be as good as the nuance that you give it. A lot of people start out with ChatGPT given a cute little question. You can write a page of instruction, but then the increased nuance beyond that for it, an influencer to understand beyond their, cute little things, sometimes these little tips that they have, or the AI, the nuance is everything. And I think that that's why until we get to the point that quantum computers are extraordinarily powerful and borderline able to read people's minds, humans like yourself are going to be super critical for a lot of reasons in financial planning. I was smiling when you were talking about the stacks of papers, because I know, the average age of advisors in Canada is roughly, what is it? I think it was 68 several years ago. It's got to be upwards of 70 now.
61 or 62, the last research study that was shown to me, but even at that point, it's still an issue.
So I've had so many advisors and colleagues of mine that are older advisors that have, taught me a lot of amazing things within finance, and I picture them. They have pictures of them like carrying these massive stacks of papers. Even my co-founder for Pocket Finance has shown me those pictures of these stacks of files because he was really grinding and going out and finding people. But even in his later years, he is so focused on quickly adopting technology. Now you can have an AI recording during your meeting, so you can look at your client, even if you want to be old school and go with the pen, so it doesn't look like you're texting somebody taking notes. It's still better just to be able to look somebody in the eye and get that summary afterwards, and maybe write down some of those nuanced parts that you don't think the AI will pick up on. But you've never seen anybody so interesting in the way he takes his notes on paper, but the meticulousness and the quality of the notes he sends to the clients and the quality of the data that goes in the CRM afterwards. And it's really good to see those advisors that are even in late in the game starting to adopt those technologies. I do want to ask you one question that I ask all of my guests. Don't hate me for it. How do you feel about MLMs in the financial advisory space? I've been tried to be recruited by all of the typical ones, all of the MLMs. I've never gone into an MLM. I've bullied my friends to get out of them. And it's not to say that there's not a model there somewhere. I've got no issue with like the Tupperwares and different things like that. There is a model, but in financial services, I'm a little bit concerned for it to be there.
Yeah, so I feel that education and training of independent advice in Canada is severely lacking. MLMs, while the compensation model often leads to poor financial outcomes for clients, at least they're attracting new people to the industry. I think that there will continue to be a need for more attraction of financial advisors in Canada, not just in the bank channel, but I do believe more regulations required to ensure that good client outcomes are coming from anybody who's calling themselves a financial advisor. And we're not seeing so many orphan clients being sold improper products by people that are not well trained enough to sell those financial products.
Yeah, and one thing I'll add is just, I think you really need to have good quality content of character at the top of those organizations, because those organizations culturally can get really weird really quick. I've heard about events where they have everybody running around in a t-shirt that has the number of the most amount of money they've made. Recently, I just had a mortgage client that I've dealt with where, and again, a Filipino lady on the East Coast, one of my favorite, sweetest clients, super, super smart with her money. And one of her people in her community got recruited to one of these MLM advisory firms. And I do love that they're adding to the industry, because recruitment is hard right now. And they're recruited usually under the most noble kind of vision. It's a kind of rah, like, we're here to help families, we're here to help those who are left behind. I love all that. It's been something I've been passionate about from early. But then, depending on the quality of the leadership in that situation, you never know what you're going to get. This lady makes, working two jobs, about 70,000 a year gross. And just tell me what your comment on this, because I don't know insurance like you do. They have her paying $1,000 a month into a UL, a universal life policy. So for me, as a not a total layman, I understand insurance to certainly a better extent than your average bear, but not like super deeply on how you construct in each situation. At the surface level, that seems quite unfitting and egregious. Am I out to lunch?
Yeah, I think there's a mass overselling of annual renewable term universal life policies that benefit the insurance company and insurance agents far more than they benefit the clients. Uh, that needs to be attacked by FISRA. There's no question in my mind. But yeah, as a percentage of income, that sounds extremely high. This particular client should have principal residence, should have their TFSA and RSP maxed before they're looking at a permanent insurance product, especially to that extent.
Yeah, and again, I won't blame the frontline person, because I think that they just are as good as the quality of the training they get. So I think that they really wanted to do the right thing for that client, but the guidance that we're getting maybe from the top level wasn't really ideal. So I will say, careful with those of you getting involved in LMs. Just be the good person, train people in the proper way. Don't try to rush through and chase a commission check. Do the right thing. Money will always come out in the wash. And especially on the East Coast, don't mess with my community. I'm coming to get you. Um, so tell me about one really crazy or interesting experience that you've had either as a fintech founder or in the financial industry. There's a lot of crazy stories. I've had people calling me to buy a $40,000 boat when they are like severely, severely behind in like so many debts, both personally and with institutions. I've heard horror stories about people sending $50,000 to another country to get developers for the technology, and then just shutting it down, duplicating the instance, selling it off, all kinds of things. What's without sharing any details about any individual or entities, what's some interesting things you've seen or experienced or heard about?
Well, something that happened over the last year, this is on my advisory practice side. I couldn't believe to the extent the banks will go to try to retain assets. So I've got an estate planning case. It's a fairly large case in the millions of dollars of assets with the bank. Client signed off for assets to be transferred. Bank rejected it. Then they said, okay, we need the power of attorney to sign off. So the power of attorney sign off, assets transfer. Bank rejected it. Said that the client then needs to have a capacity assessment to determine whether it should be the POA or the client. Still hasn't transferred the assets yet. And so we're considering, do we go to the ombudsman, try to get the client to at least be able to withdraw the money from the market. It's been a bit wild. So ultimately, I look at what's happening in our industry and I see many people on the independent advice channel sort of causing battles amongst one another. And we're already such a small community. Ultimately, I see that the more independent advice bands together and works together as a community, the better chance the consumer has against the banks' oligopolies that we have here in Canada. So that's my biggest takeaway here is we need to look at the big picture here and zoom out. It's easy for our egos maybe to get in the way of this tech platform or this MGA or this dealer or whatever. But ultimately, we're still such a small percentage of the community. You look at somebody like Matt Inglis, who's really after creditor insurance. I think that's a noble cause because the banks are the ones who are proliferating that barragement or theft from the Canadian consumer. And we as a advisory community really need to make sure that the things we're focusing on are focused on what has the best impact on the Canadian consumer, not only on our business in the grand scheme of things, because that will come out in the wash, like you said.
Well, I will give a quick shout out to Matt Inglis. I love what he's working on. I will embarrassingly admit I was #1 creditor insurance in the country for CIBC at one point when I was at the head office of mortgage, because all I knew was the silo they taught me. I did not say, and I use this analogy, and correct me if it's not fair analogy, but I always say that because once I learned what true independents like yourself do, I fell in love with it. I'm the biggest advocate in Canada because I don't do it. I can scream at the top of my lungs and peer pressure my friends, say at least go talk to one, just get the information. But it's like buying a sandwich in the airport to get creditor insurance. It's better than having no food at all, but you're paying a fairly increased price for a lesser product most often. And I would like for you to expand a bit just on what you mentioned about capacity. This is for the consumers to get a little insight. So, because that's a little bit scary to me. I've seen when I worked in big banks where the branch and the department would be fighting over assets and lending, and it'd be like battling each other because everybody's just focused on the sale and the commission. I know that this is not the nature of independence. It's to be a true fiduciary, to give the proper advice that you would give your own family members, but give the consumers that may listen to this a little bit of insight on, because that is scary. They've now said power of attorney. Now they want to evaluate on capacity. By capacity, you're talking about like their I guess mental competence and where they're at in their later age. What does that look like typically?
Well, the way I look at this is a gross overstep of power. And when you think of what happened with regards to the Emergency Act here in Canada, I don't want to get political, when banks and financial institutions try to take power away from consumers, that's an issue. And I see that as really the case in this situation where the client is losing control over their own money. And that's when they're of sound mind. They do have a POA because they are a bit older. But in this case, the bank is basically calling the shots for the client's money. So even though your assets are safe with the bank, I would never put all of my eggs in one big financial institution basket, because this is the type of scenario you might get in. And you might trust the brand that you've been banking with since you were 12 years old. I know I used to, until I started to come across these type of situations where you see what sort of influence the bank can have and how they can basically have their own set of rules. So I think consumers really do need to ensure that they've got people in their community that you could go to their house and bang on their door and say, hey man, what's going on? A lot of my clients know where I live. And if I did something poorly, I sure as heck know they would show up and say, hey, Brandon, that's not cool. That's not, I don't think ever going to happen. But if these executives at banks, when they make these decisions, knew that might happen, that might change the way that they interact with clients and not see them just as profit centers, but more so as friends in their community.
Well, I'm going to shake everybody's head, and this is not just for the consumers, but even for the financial professionals, because a lot of the times, I mean, we're all dealing with a bank. Even for you as the financial professional, you guys don't yet have your own offering where you can have your own accounts that you can give clients. So we all have to deal with the bank, and I'll shake everybody. Usually try to have a couple of different banking relationships, make sure they're competing with each other, and stop with this mindset, everyone, of I've been banking with the CBIC for 30 years. Well, it doesn't mean anything. It doesn't mean anything. I can tell you from my familiarity with these institutions, and I'm not pointing any particular ones out, but with these big banks, it doesn't matter, because I've seen many clients that have had a lot of money with them for 40 years, 50 years, a lot longer than you have been, people. And when it comes time that they need to do something and they don't fit in that perfect little box, they're not bending over backwards to try to do you some favors. You may once in a while end up having, I mean, maybe if you have many millions of dollars with the bank, they'll do you little favors, but clearly even these people with millions of dollars, they're trying to get access to their own money. So appreciate you mentioning that. I do want to ask you a little bit about financial planning for startups. So for any fintech founders or just startups in general, they're listening to this, because I saw you have a YouTube video, and I encourage you to go and check out Brandon's YouTube channel. And there's really good, simple, practical advice, good short videos, consumable, which financial literacy has not been for a really long time, because it's usually, you go to the Financial Consumer Agency of Canada's website, amazing information on there. It's all text. You got to click 40 clicks deep to try to find it. Nobody's going in there. I don't even know that most people know it exists. Isn't with financial, startups. I mean, they don't really have a lot of money in the early stages. Then they start to get investment, and they have to put that into the business. Don't you just engage financial planning for startups and startup founders when you sell it and make millions and millions of dollars?
Well, a lot of my friends started technology companies, and they didn't get a lot of interest from financial advisors and planners, and so they started making money. Now, my method for building my advisory practice was help people before they're successful, give them advice so they can make smart decisions and cement that relationship as they grow. So a lot of my content is geared towards sort of that pre-successful stage. So those early stage startups can get grants, they can bootstrap, they can leverage their network, use the benefits we have here in Canada to build their technology companies, which I'm sure you are, Sheldon. And if you work with somebody like myself who cares about you before you're big, that's the person is going to be around to help you out long term, as opposed to just when you're a profitable client. So that's sort of the method I've taken. And with this short form content, I agree. It's challenging for anyone in Canada to find high quality financial advice, or not advice, but education online. And so we're doing our best to try to distill some of the basics and some of the more advanced topics to make it easily understandable. Ultimately, that's meant to lead to, of course, a conversation eventually when that prospective client is making moves, or things get complex, or the strategy becomes not just a concept, but is actually something they're going to put into practice. I don't think that anybody should be making large financial decisions simply based on information they find online, but it's good to have a few trusted voices that you can get some basic idea about how things work, and then ideally engage your local professional on what might make sense for your own situation.
I love you for saying that. I thank you for saying that. But some of the advisors, and then I won't talk about, Canada, it's the same across the globe, are going to think you're a blasphemer because you're supposed to be only fighting over the doctors and chasing after them and stumbling and battling with all of them after them. That's, every 85% chasing the 15%. I do think there's a lot of value in that. I think there can be balance. And I think that there's a lot to be said for it. I mean, when I first graduated from high school, I got a credit card. It was very small limit. Didn't know much about it. Used it. Kind of messed up my credit. And terrible advice I got at that time from somebody at the bank in how to deal with it. Anyhow, I ended up going into Long and McQuaid. Shout out to Long and McQuaid Music Store. And I just wanted to get a guitar. And I thought, there's no way I'm going to be able to get a guitar right now. It was a really nice guitar I wanted to get, an acoustic. And they said they look at the whole picture, and they kind of want to give people a chance. And I tell you, they gave me, when I didn't have great credit, if for a brief moment in time when I was 22, this beautiful guitar, who I still have to this day. And I have been unbelievably loyal to them because they not, and it's not to say you don't want to, obviously they want to look at things, mitigate risk, their business. They don't want to just be out, letting anybody take credit. But they did take a more holistic view. They were with me when I maybe wasn't in my most desired state. And I have spent like tens of thousands of dollars at Long McQuaid since then, and I will not shop anywhere else. I don't go in and haggle about price with them, trying to, I'm just so grateful that they allowed that at that time, which leads me into my next question, I guess. At what point does someone actually need a financial plan? We talk about the underserved, the mid-market, the one that the WFGs or different companies will, always want to advocate for helping. How can these folks get advice? Because often they're left either to the teller, cute little things that they can tell them, or their uncle like myself, or, just basic advice. At what level does it look like? And is there I'm seeing in the US, there's starting to become a lot of money coaches. And I think that there's interesting new subscription models that I'm seeing people take on, and more of the cash flow behavior. So is a money coach something that's interesting that you think could have a place in Canada? When does somebody actually need to engage a financial planner? There's a lots of them that I know that won't even do insurance only. If somebody just wants to get the critical coverage, no pun intended, critical illness, but like critical, all of the coverages. Is it only for people that are making 150,000 a year? So just tell me a little bit about your thoughts on that, and advise the consumers. Okay, if I'm in a lower or mid market, where should I be getting my advice? How do I get advice? Am I, is it appropriate for me to reach out to an advisor? What type of an advisor do I reach out to? Should I just start with some term insurance and hope to engage planning later? What's your opinion on that?
There's certainly stages to financial advice and financial literacy. Uh, the vast majority of Canadians who have not spoken to an independent professional have some mutual funds at the bank, no financial plan, and they're just working. That's the typical situation. Now, I did like this meme on this recently of Mick Mahone and sort of the stages of financial advice. And the next phase, in my opinion, would be they open up a Wealthsimple account and are invested in some ETFs. So they're going to get some basic financial literacy via email from Wealthsimple. They're in lower cost products. After that, then perhaps they're talking to a wealth manager to bank. So if they did hit that threshold, they actually got a wealth manager to bank. They're providing some level of financial planning for the client. That's likely better than the Wealthsimple. Then above that, maybe you start actually talking to an independent professional. You're doing a fee for service engagement. They're not managing assets, but they're looking at your situation, building you a plan, and you're on your way. If you've got a deep relationship with a financial planner, you got them engaged longer term, I think that's probably the best case scenario, provided that they're educated, they're continually enhancing their knowledge, getting more designations, and becoming better as their clients are growing in affluence. So no matter where someone's at, I think it comes down to getting some basic information online, figuring out who's willing to take them on at their current stage. In my own practice, for example, we use Advisor Flow to basically filter through where a client's at. If they're an early stage tech entrepreneur, I'll still have a conversation with them regardless of where they're at. If they're a professional that's just getting started, I've got a junior associate that we would filter those prospects to that she would service. I'm still overseeing her work and she can bounce that off of me. But based on how somebody fills out an introductory survey, that's going to articulate where on the list they are and therefore what level of education they should be provided with. Perhaps they're just getting a few blogs. Here's a few things you might want to start with. Come back to us in a year and we can have a conversation. I think advisors shouldn't just set a minimum and say, I work with people with 500,000 assets or more, because ultimately that sends Canadians back to the bank to just keep their assets where they are. The worst case scenario, in my opinion, they could do something like, hey, you might consider a low cost option. Here's some blogs to read. Come back to me. At least they're providing enough so that Canadian can up level their net worth, get better at managing their cash flow, get better at managing debt. Ultimately, I think financial advisors should have gotten into this industry not just to make money, but to help Canadians get further ahead financially.
Well, I guess that's one of the things that we can do, that you mentioned, like just having that junior associate, because having those limits, obviously we understand that people want to have their business as in financial planning. Hopefully they have some of that content and character that has some purpose driven motivations behind it. But you can, again, that's one of the good ways to help bring people in the industry, is a lot of people just kind of start on their own and they're told by the captive agency or the independent, okay, pick the 100 people that and go solicit them, which is something I personally never really wanted to do. I want to just go out and find strangers, and then when the people that know me, friends and family, hear about what I'm doing and they're interested, they can reach out to me. But having the people that you can kind of hand it down to, and that's a great training grounds for them, because they're trying to, they will try more harder than the planners that have been doing it for a while, to try to find ways to bring value, because they're more creative. They have someone to work on. They have a client, a prospect in front of them, and they want to try to find those ways to bring value. So I think it's really good for maybe advisors to consider more often bringing in those junior associates. What is one of the biggest, and I guess even going into the the previous question again a little bit more, is the self-employed would require that financial planning a little earlier? And then what's one of the biggest mistakes? I guess the biggest obvious one, I'm not even going to allow you to do it, is the bookkeeping. They never do anything with the bookkeeping. I know so many people, friends, family, everyone else, they just nothing with the bookkeeping. 2, 3, 4 years later, they end up owing a bunch to CRA. They're trying to catch up on everything. That is probably the most obvious, biggest mistake. Outside of that, what's the biggest mistake that you see self-employed clients making, and then maybe one of the things that's easiest to get them to actually take action on. And it's not easy to give financial advice, is it? It's hard to financial plan for people. You often have to chase after them. The effort required to gather data is the number one deterrent, which is a big thing that Advisor Flow helps out with. So what is one of the biggest mistakes outside of that you've seen self-employed clients make, and then one of the easiest things you can get them to do?
Yeah, I think you nailed it. Bookkeeping is number one. But outside of that, I would say using this year's income to pay for last year's taxes and getting into this sort of cycle of not doing tax planning and not setting aside money on a regular basis, knowing that there's going to be taxes owed at the end of the year. I think it just comes down to focusing on the immediate concerns and thinking taxes is the problem for later. But ultimately, when you're talking to a good planner who works with self-employed people, they're going to be roughly gauging what your taxes are going to be. And if they're going to suggest that you set that aside in a separate account, high interest savings accounts paying 5% right now, not a bad place to be storing that tax money, and then reduce stress when tax time comes around every year. But that would be, I would say, a simple one that should be focused on by self-employed.
And then what's one of the easiest things that you actually get business owners to take advantage of or take action on? Let's say you're sitting down with somebody that's self-employed, they finally got their bookkeeping order, they're looking to kind of take a next step in financial planning. What's one of the most meaningful early things that is useful for them, and or that is easiest to get them to do because it makes a lot of sense right away?
Well, usually I always say, take a look at your insurance. If it's just a solo practitioner, a lot of times they're spending personal after-tax dollars on medical expenses. So set up a health spending account. Pretty simple to do, but it can save a good chunk of money down the road. If they've got a family, move your insurance into your corporation if you're paying for it. If you can, that will save you some extra money. But those are some simple wins, I would say, for self-employed, especially if they've got a corporation.
Excellent. And what would you say, there's a lot of kind of sometimes what feels like, subjective versus objective information out there about the value of financial advice. I know a lot of do-it-yourselfers, one that grew up just the road from me on the Wharf Road in my village, you know who you are, and they're smart people. These people that are do-it-yourselfers, they're intelligent people, which is why they feel competent, understandably. But there is certain things, I mean, if it's between myself and my wife, who's a doctor, to do a Heimlich on our daughter, I'm certainly going to pass that over to my wife. There's certain things we want to entrust, and it's hard to entrust. You need two things: you need competence, and you need the person to have a good heart or a good character, integrity. And finding those two things aligned isn't as always as easy as we'd like to be, whether it's a spouse, professional, anything else. The value of financial advice, I think, is significant. There's a lot of different stats out there. There's some that'll say, you can retire with 2.5 times what you would if you didn't. What's the simplest way, do you think, to convey or quantify the value of getting advice, and whether it's just getting advice outside of your own little world of, you think that you're managing all these things with these tools online and whatever else, but more importantly, from those proper professionals that you can find? Let's say you can find someone that's really vetted and has the education like yourself.
I think a lot of times do-it-yourselfers come from a place that they probably got misadvised or under-advised by somebody in the past, whether it's at the bank or some other place, where they weren't necessarily getting value for what they were paying. And so I think there's certainly value in doing some things yourself, whether it's investing and trying to do your own budgeting or financial planning. However, depending on what career path people are in, their time might just be better spent elsewhere. And so I do this kind of exercise with a lot of my clients, especially the ones that are making $250,000 a year. How much do they get paid per hour at work? And then I roughly will estimate how much it would cost to have an advisor involved with their financial planning. And so I think everyone should do that exercise. In the early days, my clients who spent more of their effort on growing their income and less on managing their small portfolio, those are the clients that are making the most money today, who have bought the most real estate, who have started a business, the ones that are frankly further ahead. The people who are 100% do-it-yourselfers and are so focused on what the market's doing, trying to trade and ultimately making good number of mistakes along the way, their career trajectory has not been at the pace of some of those other clients. So it really is about a time value of money conversation. Is there bad advisors that get paid too much to do too little? Yes. It might take some time to find the right advisor for you, and it might take some time to see the value that that advisor might provide. But really, I think as someone's growing their net worth from a couple $100,000 to $1 million, there's a lot of value that a financial advisor is going to provide during that time that's going to accelerate and help people avoid making costly mistakes that they might not find on a blog.
That's a good, unique answer that I haven't heard previously. I love you for saying it because I'm big on that. And the place that I learned about the term opportunity cost was within the independent financial advisory space a few years ago. It's something that I don't think I had really considered enough in my life up to that point. And it's very, very true. It's a really interesting approach. I think it's a great thing to look at with your clients. And I've always, so in the last 5 years, I haven't done it a lot, but there's been periods where I've been like, okay, I sit down and talk to my wife. Again, we have a lot of goals we want to achieve. What is the time worth? So we're both very domestic. We're both like able to get down on our hands and knees and scrub the figure eights on the floor, with a cloth, and bake and cook and do all those things. But at some point we said, it's getting kind of crazy having a child. Maybe we should have someone come in a couple times a month to do some cleaning. This will make things a lot easier for us to reallocate that time to the things that we want to be able to achieve. So I think that's a great thing to be able to do with your clients, because even if they can do it, is that the highest, best use of their time? And often that can potentially be reallocated into something that's going to bring a lot more value. I mean, if they really enjoy doing it and brings them happiness, that's maybe a different ballgame. But I doubt with most people that it's happiness versus a mental labor that they're going through. So I love that you said that. And I love that you do that kind of thing with your clients, because it does really help them rethink something I think that doesn't get rethought enough. If you were instantly 25 years old, you're not fresh out of high school, you've got a little more sense, your brain's a little more developed, and you're tasked with being the greatest financial advisor ever, what are some of the things that you'd look to set upon yourself to succeed quickly? Is it just embrace the old school calling? Is it all of these older advisors buying those retired books?
I'd find at least a couple of mentors. I'd find somebody who's in their 50s or 60s who's been in the industry a long time and has a lot of wisdom. And then I'd find another advisor in their 30s and 40s who has adopted technology in their business. I'm a firm believer in there being value in the way things were done and the value in how things will be done. And I think the best advisors are going to take a blend of both and really internalize the value of a long-term financial planning engagement with the innovation of technology and the ease of use that comes with software programs that are built to enhance the client experience. From there, I would make sure to get some designations to learn, educate myself, and grow my practice slowly over time, as opposed to trying to quickly buy books. Those will probably come at some point if advisors are out there and are meeting other older advisors. And if they're doing right by their clients, they'll be able to organically grow. Because if you just buy books and you don't know who you are and why you're doing what you're doing, you're going to end up with a business that doesn't really reflect you.
Totally agree. And I've seen advisors come in just with the hopes of, being open to build it organically, but really they're focused on, I want to buy a book. Where's the book? I want to buy a book. But I think that can come with some, lack of focus. So you also mentioned, so I know that, the idea of if they have a junior associate, then they can, they can still help a client. They can pawn off the clients that are not their ideal clients down to them and make sure that the client is still getting some support, which is great. But it sounds like you think maybe the older advisors can actually get some real value and fresh thinking, some innovation. Tell me a little bit about that, because most advisors that are, shouldn't say most, many advisors that are in their older years, they're good with the way things are. They want to retire, just, they don't want to make a bunch of changes, but I don't think they realize the opportunity cost of, you're going to go and sell your book of business. I know a guy in the West, gentleman who's a little bit younger than us. I think we're around the same age, Brandon. And he was buying a book from a 70-year-old guy, 1,200 clients. And he told me during the call, and I wasn't probing for this. It was just something kind of he brought up when he talked about the chaotic systems he was adopting. He said, I would have paid, and he used the words significantly more for this book of business if it wasn't all manual and in a bunch of folders and there had been like some actual like, so I guess it's almost like when you go to sell a house, like sure, you could just sell it the way it is and it's got some creaks and cracks and stuff like that. But if you just spend a little bit of money before you sell it, getting things in order, then you're going to be able to probably substantially increase the price of that book of business. So there's some real value there in bringing in.
Totally. So there's a senior advisor that I'll be buying his block from. He'll be retiring in the next year or so. And the process that we took was, first of all, help digitize his files. So one of my staff actually went into his office and scanned everything and organized it in a file storage system sync that I'm using. The next phase we've been doing is we're using the same assistant. And so she understands his processes, she understands my processes, and we're bringing them together. He now is using Advisor Flow. When I say he's using it, I mean our shared assistant is using it with his client meetings and sending out financial overview to gather information and ensure it's stored in our cloud-based system in an organized fashion with our open API. So what we're doing is really bridging the gap between the way things were done to the way things will be done moving forward, while not jeopardizing the way his clients are used to working with him. He's been in the industry 40 years. His clients are working with him for a particular reason. We're not looking to change that per se, but the clients of his, the kids of his clients, they expect a different user experience. And that's where we're integrating things like Advisor Flow and Hey Advisor. And once we build an integration into Pocket, I'm sure that's going to be another opportunity to help build a fence around that next generation of clients that ultimately will be inheriting a lot of this wealth or is building it themselves.
Good. Well, I want you before we finish off to help me kind of plug both of your businesses. I can tell you that I've known Brandon for. I mean, perception of time is pretty bad when you're an entrepreneur. Sometimes I have a hard enough time remembering what province I'm in. But I've known Brandon certainly for over a year. Been watching his LinkedIn posts for quite some time now. A good dude, highly competent, knows his stuff. On the financial planning side, tell us what your ideal client looks like that you can help, and really where people will be able to reach you for the financial planning side. And then shout out to the financial professionals and the advisors that can use your Advisor Flow, and how they can reach out, what that looks like to adopt, and just plug your business a little bit for us.
Thanks, Sheldon. You're too kind. Well, on the advisory business, LinkedIn is the place to connect with me. You can check us out on Instagram or TikTok as well. It's the hashtag there is Billions with Brandon. Who I'm looking to work with for my advisory business, it's a tech business owner or professional that is doing well or starting to do well, but doesn't have an advisory relationship or doesn't feel like they're getting value from their current relationship. Those are the ideal people I like to work with. I like innovative projects and I like innovation in general. So I just find it interesting to learn from people who are innovating in spaces outside of finance, and see where those industries are going. So regardless of whether I make cash on those clients, if they're solving interesting problems, those are conversations that I enjoy having. On the Advisor Flow end, we're really focused right now on actually this advisor succession and teaming problem. And so the case study I just spoke about in my own practice, we're finding this as being a common trend among other advisors in Canada that are partnering up with more senior advisors. And so if you're a more senior advisor and you're looking to increase the value of your book, do go to advisorflow.ca and check our platform out. If you're a junior advisor and is trying to find ways to make it easier to transition books into your book of business, should also check out our product and check out a couple of our webinars coming up in the fall. So hopefully that helps, Sheldon. Thank you for the opportunity.
And thank you so much for coming on, Brandon. And I will say again, folks, if you're looking for financial planning or you want to refer one of your family members, that they could use some additional insight. Maybe they're paying too much tax. Maybe they have $1 million sitting in a checking account, like most of the people from my village, and not collecting any interest on it. Brandon is someone I would send my mom to. You should send your mom to him too, and yourself if you're interested in planning. Obviously, like you said, he's got his high level advisor, he's got his junior associates that he oversees. And with Advisor Flow, I look forward to a day where we can continue to integrate, create that bigger ecosystem, bring more value to clients and professionals, and lead the way into a future in Canada where we've got a lot more innovation going on that we can bring the value that Europe and the US is bringing to their clients. And the Canadian Bankers Association, you're not going to block us from doing that, getting that consumer information out to consumers, which they truly own their information. The banks don't own the information. The Canadian Bankers Association doesn't own the information. The government doesn't own that information. You own your own information. So empower yourself. Look at yourself as professionals and consumers. What tech stacks am I using to make sure I'm getting the best financial outputs in my life, and that I'm able to take care of that opportunity cost and purposefully allocate that time to my family, to earning extra income, to greater ambitions. And super grateful that you gave us some of your time today, Brandon.